Okay, thank you all for joining us. We'd like to start right now so that those of you who joined us earlier don't have to wait too long. So welcome all once again to this webinar. My name is Harry, and together with me is Touting.
Everyone.
Yep, and we're from the investment team at Money Hour. So today we'll be talking about the basic principles of investing, which every beginner can learn in their sleep. But don't fall asleep just yet, right? Stay with us, stay awake, and over the next 1 hour or so, we'll be sharing these investment principles with you. Right? Before that, let me just briefly introduce who Money Owl is. Now, Money Owl is a financial advisory firm, and we are Singapore's first bionic financial advisor. Now, what this means is that we take the best of what humans and technology can do, and we combine it to deliver the best-in-class advice for our clients. Now, in addition to investments, which you're going to hear about today, we also provide insurance, will writing, comprehensive financial planning, and we integrate all that with national schemes such as the CPF. Now, we are a social enterprise. Essentially, we are a joint venture between NTUC Enterprise as well as Provident, both of whom have decades of experience doing good and doing right. Our core purpose, as stated here, is to empower people to live fulfilling lives by helping them make wise money decisions easily and confidently. All right. Before that, and to kick us off, I believe we have some questions for the audience, right, Hao-Ting? I think you're on mute. I think you need to unmute yourself.
Yeah, hi. Thanks, Harry. Yep, so to make things a little bit more interactive for us and to get us all warm up for the night, right, we just want to ask 3 simple questions to the ground, right, to understand how you feel about investing, okay? So actually, if you notice at the bottom of the page, you'll see this chat feature, right? So you can use this chat feature to type in your responses. Okay, so there's no right or wrong answer, just for us to know you a little bit better. Okay, so for the first question, we would just want to ask, in one word, how would you describe investing? Okay, so what comes to your mind when you think about investing? Okay, so feel free to write the answers in the chat. Right, okay, thanks Kim Lin and Su Hui. So we see that, okay, there's a lot of negative emotions, right? Generally, we see confused, we see roller coaster, we see risk. Okay, so it seems like difficult. Okay, right, thanks Alan for the $3 signs. Right, buying future, correct. Okay, so I think half of us, we associate investing with emotions. And typically, we associate them with quite negative emotions, right? So this is quite common actually, because as humans, it's natural for us to feel emotions, right? Especially when what we are dealing with is tens of thousands of dollars or hundreds of thousands of dollars on the line, right? Not sure whether we'll get our capital back, right? And some of us who even, okay, for those seasoned investors who have already been putting money into the markets, sometimes our emotions may get the better of us, and we may procrastinate, right, before we actually put our first dollar in. Right, so today, Harry and I would like to address these concepts and these issues in a webinar, and hope everyone will feel more comfortable with investing at the end of the day. Okay, so for the second question, right, we also want to ask, right, from a scale of 1 to 5, how important do you think investing is? Right, 1 being the least important, 5 being the most important. Okay, right, thanks, right, I see a 5. Okay, so good. It seems that most of us, right, Alan says 7, right? So most of us are actually very, okay, we think that investing is actually important to reach our goals, right? So it seems that we're all on the same page today, right? So for the third question, right, knowing how important investing is to our lives, how many of us here are currently investing, right? So if you are, click, okay, you can type Y. If you're not, you can type N. Okay, wow, see a lot of Y here, okay? Almost everyone has started investing.
I thought this talk was for beginners, but of course, welcome everyone.
Yeah, our main audience is for people who haven't started investing with us or investing at all. But most of us here seems to have invested, but no worries. Okay, take this session as like a reminder to remind you what the perspectives to take. Okay, when you're investing and how to manage our emotions when we hear market noise along the way. Okay. So that being said, maybe Harry, you would like to start us off with why we need to invest in the first place?
Yeah, thanks, Touting. So I think the first point to make here is that investing is different from speculating. When you speculate, what you're trying to do is you're trying to get a very high return in a very short span of time. And that usually involves taking on a very high risk. More often than not, it's typically driven by greed, and you're also counting on having a bit of luck as well. So it's quite similar to gambling, right? Whereas investing, generally speaking, is where you aim to grow your wealth over a longer term, while taking on an appropriate level of risk for you, of course, which is hopefully based on evidence and rationality. And we'll be touching more on these as we go along. Now, back to the question, why the need to invest? So you can think about investing as a way to give you more options later on in life, such as when you can be financially independent and retire, or how much you can afford for your children's education, or any other aspirations you may have. But it takes time to build your wealth towards something big, like financial independence for retirement. Let me illustrate. Now imagine this line here represents your life. And for most of us, our average lifespan will be around 85 years or so. You may be working now, but at some point, you're going to have to stop working. Now, suppose this dotted line in the middle here represents when you expect to retire. It could be 45, 55, or 65 years old. However, before you can have the option of retiring, you need to consider whether you are already financially independent. There are many definitions of financial independence, but one definition I like says that financial independence is when you have a fully paid house and a sum of money that will allow you to support yourself for the rest of your life. So it sounds simple enough. Now, we all know what it means to have a fully paid house, but a bit less clear for us maybe how much this sum of money should be. Now, let's say you have 20 years from now until retire for the purpose of today's example. Now, during this time, you are still working and are gradually building up your earning power and accumulating assets. But these are also the years where you spend the most because you need to take care of your families, pay for your house and your bills, go on holidays, and so on. And between when you retire till the end of the road at 85, that is when you are no longer earning a salary. But due to lifestyle changes as we grow older, you're also not likely to be spending as much as you did before retirement. Now, for this example, let's say you need 3K a month after you retire, or around 36K a year. Not a lavish amount by any means, but sufficient. However, you're only retiring 20 years from now, right? So if you need 3K today, you need much more in 20 years' time, right? Because of inflation. So I think we all know what inflation is. It's just like how you could get a cup of coffee at the kopitiam for 50, 60 cents 20 years ago, but now you need to pay more than double for the same thing, right? So at an inflation rate of say 2.5%, which is the average inflation rate in Singapore over the last years, in 20 years' time, you actually need around 60K a year, right? And let's say you expect to be in retirement for 20 years, which means that from the moment you retire until the end of the road for you, let's just say that's 20 years. So just a simple math would mean that you need at least 1.2 million at the start of your retirement to be financially independent. And here I didn't even take into account the inflation which happens from your retirement day onwards. I'm just using a flat, simple mathematical calculation. Now, on top of that, many of us have children and aspire to send them for higher education, right? So we need to set aside some money for their tuition fees as well as their living expense. The concept of inflation is the same here. So for a typical 4-year university course, which could cost you around 48K today, in 20 years' time, this will be more than 150K. You may be surprised to know that the cost of education is rising faster than the usual rate of inflation that you hear about, right? And then, of course, inflation also applies to living expenses. So housing, your schooling years are probably a little bit more recent for you than for me, right? Now, how much did you pay for your education?
For me, it's slightly cheaper. I spent around 45,000 for 4 years. But some of my friends, those who study law or medicine, or who go overseas to study, they may pay more than twice this amount, right? So this is quite a conservative estimate.
Yeah, and we're talking about local education, right? Because if you have to send your children for an overseas education, I think the numbers will look completely different. But for today, let's just stick to a local university education on a regular non-medicine course, right? What that works out to be is around 200K per child. And let's say you have 2 child, that comes up to 400K. That means that overall, you're looking at a sum of at least 1.6 million plus a fully paid house before you can be financially independent and consider retirement.
1.6 million is actually a huge amount of money, right?
That looks big to me.
Yeah, so actually, if you were to put it into perspective, right? So if we start off with 250K today, right, then every year we are putting in an additional $14,000 every single year for a period of 20 years, right? What we are going to end up with is somewhere that is not even half of what we are supposed to, what we want to accumulate towards, which is $1.6 million, right? So this is assuming that we put in a bank account that gives us around 1% per annum, right? So if you look at today's bank deposit rates, right, even fixed deposits, they can hardly give, a rate of return that is more than 1%, right? So assuming it's 1%, we are so far off from our goal of 1.6, right? But if you were to put this same amount of money, right, and this strategy you're putting in $14,000 every year, we are going to get something that is very close at around $1.5 million. Okay, so some of you all may say that, right, this 7% here is actually extremely high, right? So in actual fact, in reality, we may or may not get this 7%, right? We may get something that is lower, right? Something that's higher. But this illustration is just trying to prove the point that if we were to put our money in a normal bank saving account, we are not going to reach our goal anytime soon. Okay, so some of us may be thinking, right, how come with a 6% difference in compounded rate of return, we're able to make such a large difference? Okay, so the reason actually lies with the power of compound interest, right? I believe that most of us already know what this compound interest is, right? But for those who don't, right, compound interest is actually what makes your wealth grow at an increasing rate, right? So your wealth doesn't just increase in a linear fashion, right? Looking at this table, if we put in 20K at year 0 at 5% per annum compound rate of return, in the first year, we may be getting something like $1,000, right? So the second year, we are not just getting another 1,000, but we are getting 1,050. So you can see that this difference actually increases over time, right? Increasing at an increasing rate, and therefore you see a very nice upward curve like that, right? That explains how come the difference is so large. Okay, so knowing the power of compound interest, we cannot stress enough the need for us to start investing early, right? Because the earlier we start, the easier it gets. So for example, for myself, right, I'm 27 this year. Okay, so for myself, if I want to reach a goal of 1.6 million at 60 years old, I only need to invest $11,500. And basically, this is what I'm doing for myself, for my own retirement goals, right? So compare this with someone who is already 45 years old this year, right? If you're only investing this year at 45, you need to put in a lot more, right? We're looking at an amount that is around 5 times the amount, right? 5 times of $11,000. And looking at the total commitment we need to put in is also a lot larger, right? So in total, we see around 952,000 that we need to put in age 45. But if you are 25 or even younger, we don't have to put in so much. Okay, so some of us may be thinking, right, as I grow older, my income will increase. And so this amount wouldn't be too much of a stress to me. Okay, but don't forget, as you grow older, you also have more commitments in your life. Okay, your kids are going to grow older. They may be going to university, right? They may need tuition fees. You may be planning for a family vacation. Your friends already got a new house. You also want to upgrade. So all this, okay, adds on to your burden, right? So sometimes having to fork up such a large amount for your retirement goal, right, requires you to take away some of the things that you love, right? You have to forego your short-term goals and things like that. Okay, so some people may say, I already know all these things. Okay, so why are we still not investing? Right? Just now we asked how many people are investing. We see a few no's. Right? Some of y'all may already know all these things, but the world of investing is extremely complex. Right? You may not know who to choose. You may not know who to trust. Right? And on the internet, if you type in investing, you're going to see a lot of answers being thrown at you. Right? People are going to say, oh, invest in options. Right? Invest in ETFs. Invest in REITs. Okay, so what are all these complicated names about? Right, so for today, we are not going so deep in because this is meant to be a foundational course. So what we are going to do is just going to share with you what are the 6 most common Lego bricks of investment. Right, I like to use the word Lego bricks because all these investments in the world can actually be distilled into these 6 simple components. Right, so here we have stocks, bonds, cash, commodities, real estate, as well as alternatives. So what you hear about gold and silver and oil and gas, okay, they belong to commodities. Right? When we talk about REITs, we are talking about real estate and such. Okay, so for today, we just actually want to zoom into stocks, bonds, and cash, because these are the primary methods, right, through which the investments are being allocated.
Yeah, and for I think 99% of all investors, these three instruments would be more than enough, I think.
Yeah, exactly right. So what are stocks and bonds? Okay, so for those who may not have heard about stocks and bonds and do not know how they work, right? So here's just a simple explanation, right? So stocks and bonds are actually the primary ways through which public companies and governments get capital from us, right? Like people like me and you. So from the investment point of view, from the investor point of view, when company issue bonds to us, we're actually lending them a sum of money, right, for a period of 5 years, 10 years, 20 years, and so on. So as a way to thank us for putting the money with them and taking on a little bit of risk, these companies or governments may pay us some interest, which we call coupons, right? Every 6 months, they may pay us a little bit. At the end of this maturity, at maturity, after this 10 or 15 years, they will give us the capital back. Okay, so looking at the characteristics of bonds, we can see that it's a little bit safer. It's a little bit safe, right? Because the companies are actually obliged to give you back the money. But sometimes there may be a little bit of risk involved, right? Especially if the issuer or the person issuing the bonds, right, may not have a very high credit rating, right? So in the case that they go bankrupt, you may or may not recover all your money back. So another way for companies to get money from us is by issuing stocks. So as a stockholder, what we are doing is that we are not lending these companies money. Right? What we are doing is actually buying a piece of ownership in the company. Okay, so how do stock prices go up and down? Right? So when more people are optimistic about the future of a company, right, than people who are pessimistic about where the company is heading to, right, there will be more demand than supply. Okay, and these market forces actually drive the price of stock upwards. So the converse is also true. If a lot of people, they think that the company is going down or the earnings are going to decline in the near future, they may sell the stocks more than they buy the stocks, and the share price will drop. Okay, so here's just a simple summary of what we've mentioned so far. So with stocks, usually the return is higher, right, but the risk is higher as well. For bonds, risk is low, returns are low. Here we also want to bring up another asset class, which is cash. Okay, so a lot of people think that cash is a kind of savings, but we tend to think of cash as a kind of investment as well. So money that you put in your bank fixed deposit, right? Money that you put with cash solutions. For example, in Money Hour, we have this thing called a Y Saver, right? If you are updated with our solutions. So this Y Saver portfolio actually puts your money in various Singapore fixed deposits, right? So as you have expected, the risk is extremely low, but the return is not so high as well. Okay, so usually if you have emergency funds, we recommend that you put the emergency funds into cash rather than stocks and bonds. Okay, so here's a graph that shows the historical returns of stocks versus bonds and versus cash. So I think one thing that we're able to see, okay, in a very obvious way, is that stocks generally move faster, okay, they grow higher and faster than bonds as well as cash. Okay, so here we are using the US Small Cap Index and US Large Cap Index as a representation of stocks in general. Right, for bonds, we're using Long-Term Government Bond Index, and for cash, we are using Treasury bills. And of course, you have the inflation rate. Right, so notice that here we are looking at a long period of 100 years. We are not looking at a short time period.
Yeah, Hao Ting, I really like this chart because it shows again why it's so important to invest, right? Because it helps to grow money at a faster rate than inflation, no matter which instrument you pick, right? But look at this chart, like stocks or equities actually has the highest return. So does it mean for us, we should all just invest all our money in stocks?
Actually, yes, Harry. So stocks actually have a higher expected rate of return. So ideally, we want to put, we want to have a lot of stock allocation in our portfolio, right? But this is assuming that it's for a long period of 100 years. Okay, what if we only have like 5 to 6 years of investment time horizon? Okay, if we notice, right, the shape of the curve, it can be quite rough at certain times, right? If you look at the period 1967 to 1978, we see there's this period of decline over here, right? So if you only have 5 years of time horizon, and then you happen to come in somewhere around here, right? What you're going to do is that you may not be able to reach your goals, right? So for people who have, a lower risk tolerance, right, or do not have such a long time horizon, we recommend that we put in a little bit of bond allocation into our portfolio to dampen that volatility, right? So that you can sleep better at night, and so that you can also stay invested, right, and have a higher chance of success to reach your goals, right? So some of us may say, right, in fact, just yesterday, I was sharing this slide with my father, right, before I decided to use it for today's webinar. So he mentions that what I'm showing is not really so accurate. Okay, why? Because he has bought 3 companies' stocks, right? 2 from US and 1 from Singapore. And adding up all his return, he said that he actually made a loss over a period of 20 years. Although 20 years is a long time, right? But he has made a loss. So this is untrue. This is what he said. Okay, but the difference is that here we are using this thing called an index. Okay, so index is actually a representation of hundreds or thousands of companies that represent a certain market segment, right, or a sector. Okay, so it's a highly diversified group of companies we're looking at. Okay, but this is not true for a single company. This. Okay, so this one I got from Yahoo Finance is the price. Okay, this is the share price over time. So can anyone guess, right, what company is this?
This is based in the US, right?
Yes, correct. So the clue that this is based in US. It's a tech stock, really popular nowadays. So can anyone guess what company is this?
So they can type in the chat if you know the answer.
Yep, so YZ Co is correct, right? So this is none other than Apple. Okay, so you can say, what if I'm so lucky to invest in this period? Okay, and then I sell it now. Okay, so in fact, Apple has gone up by more than 56% year to date. Okay, so if I'm invested in this, say 1st January, I'll be so much richer now. However, this is not true for all stocks. What if you're unlucky and then, you invested in this other company instead? This is also a tech company, right, listed in the United States. Okay, but how come, okay, that performance is so different from what we see in Apple? Okay, so during this period, you can see the curve, okay, going up. It's like how Apple has performed, right? So this company is known as General Electric, right, for some people who know. So this company is really famous for making engines, right? So during this time when, the aviation industry really took off, right, there's a huge demand for engines, you really see the stock price, okay, skyrocketing. However, after the dot-com bubble, things start to get south for various reasons. They may not, okay, they are unable to recover to where they were in the past. So some of you may think that, okay, General Electric gives dividends, right? For this chart, this is just the share price. So here, we're showing you the total returns of General Electric versus the wider index, okay, known as the S&P 500. So this S&P 500 is an index that follows the biggest 500 companies in the United States. So here, I think the trend is quite obvious, right? So the blue line, which represents General Electric, is a lot more volatile. And look at the last 5 years, right? The performance, okay, is nowhere near that of the general market. So some of us may say, right, US stocks are very risky. How about Singapore stocks? I live in Singapore, and so I should be more wary about, the things that's happening here, right? My investments are also more insulated from things like, currency fluctuations. We're insulated from things like political events that's happening in the United States, okay? Although this is true to a certain extent, right? The stock price can be affected by a multitude of factors. Some of them we know, some of them we may not even know. So here I've got another example. This is a really popular stock, okay, back then in the, like around 10 years ago or 20 years ago, right? So can anyone try to guess what company this is again?
Yeah, again, type it into the chat if you know the answer.
Shell. Okay, it's also a tech company, right? Singtel. Okay, Singtel is quite popular nowadays, but this company, right, used to be popular in the past, right? Year 2000. Creative, right? So Grace is absolutely right. So I think, Harry, you have invested in this company before, right?
Yeah, that's right. Yeah. So unfortunately, I personally invested in this stock, over this time period, and I still have the scars to show for it. Yeah. So I know a thing or two about this company actually, having invested in it. So this is Singapore's very own tech superstar back in the 1990s. In fact, it was the first Singapore firm to be listed on the Nasdaq in the US, best known for its Sound Blaster sound cards at a time when PCs didn't come with sound, right? I think, yeah. I don't know if you're actually old enough to remember such a time. Do you?
I'm actually old enough to live through the period. So back then when I was in primary school, I remember many of us, we were holding these MP3 players. So they come in all sorts of colors, right? But now we have the Apple devices, iPods and iPads.
Yeah, that's right. So MP3 was the other thing, right? In addition to sound cards, which it did very well in, all the way until the Apple iPod came along, and it went downhill from there, right? At one point in time, Creative sold for almost, or rather in excess of $50. Now you can see from the chart here, the stock price is about $2.50. So quite
so the disclaimer here is that we're not trying to say Creative is a bad company to invest in. Right? In fact, I pretty like their products. Right nowadays, they're going to this thing called the X5. The range, I'm into sound, so I quite like their products. But one thing that we want to tell you guys is that investing in single companies can be extremely risky. Right? Who knows, Creative may one day skyrocket again. We will know, right? Just like Apple or General Electric, we will know. But we just want to show you that within short periods of time, how volatile can single company stocks be? So here's, again, right, it's a chart showing the total returns of the company Creative Technology versus the SDI, right? So SDI is the Straits Times Index. Okay, so usually when people say the Singapore market is going up, Singapore market going down, what we're looking at is actually this thing called the SDI index. But in Chinese, right, we call it the 海峡指数, right? Okay, so many of us, may know what this SDI means. So if you look across this 20-year period, the SDI is actually going up at around 4% per year, positive 4. How about Creative Technology? Within this period, it has a performance of negative 7% per annum. Okay, remember, back in my earlier slides, we talked about the amount of money we need to accumulate, right? And we're looking at 7% per annum here. Okay, here, if you had put in most of your money or investable assets into Creative, okay, I'm sorry about that, right? The returns you are getting is not 7%, but negative 7%. All right. So I hope Harry didn't put too much money in here, right? Because
yeah, well, it was quite a bit for me back then, to be honest.
Oh, you put in quite a lot. I wish you all the best. Right? So I hope you are heavily diversified into other sorts of investments as well, right?
Yeah, so I've learned better since then, I think, which brings us nicely into the next slide, which I want to talk a little bit about diversification, right? So, Hao Ting is talking about the risk of holding a single stock. But what you often hear investors talk about is diversification. So what that basically means is that you don't put all your eggs in one basket or even just a few baskets. Because if you hold one or two stocks and they fail, then like Creative or GE, you may never recover back to what it was before. Instead, if you buy the stocks of as many companies from as many sectors and countries as possible, you then proportionally reduce your risk, right? So the other benefit of diversification is that the more stocks you hold, the better your chances are of holding on to winning stocks, right? Because in every market period, there'll be regions, sectors, and stocks that do well, and those that don't. Right? It may not be possible to predict who the winners will be, but when you own a lot of stocks in a globally diversified portfolio, you're likely to always hold and own the winning stock of the day. Now, to illustrate, let's take a look at this chart here before us, which shows the benefits of diversification. The one before, yeah, this one. Now, all stocks here, which is the the yellow bar, represents a market return, which is basically the return you would get if you had got all the stocks available to you in the world, held in proportion to each stock's market value. The market return here is 7.9% on average over this long-term period. Now, if you try to pick stocks and you get it right, of course, you may get more than 7.9%. But if you miss out on the top performing stocks each year, which by the way changes every year because we never know who the top performers will be, you may actually reduce your percentage of returns to just 3.6% or even risk negative returns, right?
So is it possible to buy, all the stocks in a certain index, since you said that diversification is so important?
Well, the thing is that you don't need to, which brings us to mutual funds, right? The next slide, which is mutual funds, which is more commonly known as unit trusts in Singapore. So unit trusts are investments where a fund manager pools your money together with all other investors to purchase a collection of stocks, bonds, or other securities. So if you buy a global mutual fund made up of equities or stocks, instead of owning the shares of just one company, you become a shareholder of many companies across the world and participate in all their productive activity, right? Or in other words, you start to participate in the global economic growth. So in general, there are two broad ways which fund managers can invest, which you can see here on the slide: active investing and market-based investing. In active investing, the fund manager aims to beat the market by being smarter, better, and faster than everyone else, right? They attempt to do this by picking the stock sectors or countries that will do better than the rest. Or they would time the market, buying low, selling high, based on their own analysis and forecasts. Now, the second way which Money Owl recommends actually is market-based investing. Now, earlier Hao Ting asked me about owning a globally diversified portfolio to capture a market return. So that's what market-based investing basically is. This approach aims to capture the market return by investing in a broad, globally diversified portfolio without guessing or forecasting what to buy, right? Market-based investing is also about staying invested in markets throughout the short-term ups and downs, rather than moving in and out of the market. I will be talking a little bit more about this later on. Yep.
So Harry, it seems that active investing can be quite attractive also, right? Because it seems to be able to outperform the market sometimes.
Yeah, well, yeah, it is very intuitive. I know that active management is very intuitive. Buy low, sell high, and all that. But it's actually easier to explain why we don't recommend active investing in order to see why Money Owl actually likes market-based investing instead, right? So looking at this active investing, which is timing the market and all that, you would think that a professional fund manager would be able to do this job well enough to outperform the market, right? However, consider this chart, right? This looks at the US-based mutual fund performance across 20 years, right? We can see from the top chart here that during this time period, only 23% of active fund managers who invest in stocks have survived and managed to beat their benchmark. And by the way, these benchmarks are usually represented by a market return, some sort of market index. The picture gets worse if we look at active bond fund managers, where it's only 8%. So in fact, most active managers are not able to actually pick the right stocks or time the market in the right way to give you a better return than the market. So looking at this, the odds of getting a better return from active investing is really not in your favor. So it's easy to see why then Money Owl actually recommends for you to do market-based investing instead.
Yeah, I see, Harry. So actually, there's a reason why this is even happening, right? So here on the slide, you can see a simple explanation. Okay, actually, it's not so simple to understand, right? So that brings me to the next slide, where we talk about why active fund managers are not performing so well, right? So the reason is actually because, right, mispricing of securities is hard to do consistently, right? Because this is based on a well-known theory called the efficient markets theory or hypothesis. So I'm not sure whether you guys have heard about this theory before, right? So years of research as well as this theory, right, assumes that market prices have already reflects all available information in the market about the stock, right? So to put it simpler, right, it is very hard for us to find a price, right, that is more accurate than current price of the current market price. Okay, I understand that many of you are scratching your head, right? It's not something that's easy to explain or understand even, right? So here's a very simple explanation or a story, right, to try and drive home this point, right? So at the client event hosted by a financial advisor, right, what this advisor did is that he has this jar of jelly beans that is put on the lobby, right, on the table on the lobby, right? So when the participants entered through the door, right, they were requested to actually estimate the number of jelly beans in this jar by writing the number on a piece of paper. So as we have expected, the range is very huge, right? Some people wrote 409, some people wrote, okay, sorry for the typo here. Okay, some people wrote 5,000 plus. Okay, so the range is extremely large, but the actual number is actually 1,670. Okay, very far away. However, if we were to take the average of all these responses, right, the average is going to be a number that is extremely close, right? 1,653, just 17 jelly beans away from the actual number. So I hope everyone can see how similar this story is, right, to this efficient markets hypothesis, right, whereby we see that the collective wisdom of all the investors is going to be more accurate than the knowledge of just a single person, right? And that's why it's extremely hard for us, you know, to beat the market price, right? So what fund managers they're doing behind the desk, right, is actually trying to find out what is the accurate price of a certain stock. So for example, stock A is trading at $50, right? The fund manager or the analyst in the fund house may think that this $50 is not accurate, right? It should be actually $55 per share. So what they will do is that they may buy it at $50 and sell it not at 54, not at 56, but at $55, right? To try and get a profit from there. Okay, but this theory, as well as the research, has shown that this is extremely hard to do, right? So some of us may say, what if I pick the best fund manager out there who is able to consistently, you know, pick the right stocks at the right time and guess what is the accurate price of the stock, the intrinsic value of the stock. So here we just want to debunk the myth by using this Observer Portfolio Challenge as an example, right? So the Observer is actually a British newspaper. So what they did is that they have this competition that pitted professionals, okay, like fund managers, with students of finance. And this mystery subject we call Orlando for now. Okay, so each of these teams are given the same amount of money, 5,000 British pounds, right, to try and stock pick and beat the rest, okay, in stock picking, right? So after 1 year, right, we look at the results and see which team actually got the most amount of money. Okay, so the results came out. Professionals got 5,176, students 4,840, but this Orlando, right, who is this person, right? Is he a nickname? Is this a nickname for Warren Buffett or some star fund manager? Right, the answer is no. Orlando is none other than a cat. Okay, so this cat, what it does is that, okay, it randomly picks the stocks by throwing a toy mouse on a grid of numbers that's associated with different companies. Okay, so this portfolio challenge raised the question of whether professionals with their 10 or 20 years of experience can outperform just a random selection of stocks made by a cat. Okay, so if today you have $100,000, who would you want to put your money with? Do you want to put your money with active fund managers and have to pay hefty fees for that? Or would you put your money in a market-based investing vehicle like what Money Hour has, right? Whereby we do not try to guess or forecast where prices will go. We trust the market, we stay invested, and we are very globally diversified.
Yeah, thanks for that, Touting. So we spoke about two broad ways fund managers invest, but what about yourself as an investor? Because even if you invested in a market-based fund, the decision to buy or sell an investment is still your personal decision to make, isn't it? Because if you have a buy low, sell high mindset, then investing can become an emotional roller coaster ride for you. And those emotions will impact your investment decisions. So what do I mean, right? So imagine this curvy line here represents the stock market prices over time. When prices are going up, investors like yourselves are filled with optimism and they tend to react by buying into the stock, right? And they are happy when the prices continue to go up. But when the prices come down, investors get nervous and there's a and there's a fear of losing more money. So they react by selling. That sounds familiar, right? So that what happens is that you follow a reactive cycle, which leads to poor decisions at the worst of times, right? Where you end up buying at higher prices and then turning paper loss into permanent losses. Right? I think there's an animation that actually shows that as well. I think that's right. Yeah, this one. So after a while, right, you're turning your paper losses into permanent losses, and then you have to experience the stress of watching the markets climb back up again when you have just sold, and then it becomes over, and then this happens over and over again. Right. So I think one thing we have to know is that it's the nature of stock market to fluctuate. And reacting based on short-term movements may give you a lower return compared to staying invested through the ups and downs. So maybe we go to the next slide and take a look at this one. Right? Take a look at this chart where the left-hand most bar shows the S&P 500, which is a US based market index, having an annualized return of almost 10%, 9.96%. However, if you're not invested throughout this period, of 1990 to 2019, so almost 30 years. If not invested, if you're not invested and missed out on just 20, if you're invested but missed out on the 25 best single days of return in this almost 30-year period, it can cause your annualized return to drop by half to just 5%. Right, 5% is actually the right-hand most shortest blue bar. So I don't have my calculator with me, but between 1990 to 2019, there must be something like more than 10,000 days. And if you just miss out on 25 days, which can easily happen, right? If you try to time your market or react to your emotions, you could end up with a much less return than you thought. Now we can go to the next slide. Right? And so earlier we spoke about market-based investing. We touched on this point about staying invested. Now, it may not feel natural for many of us, but sometimes when it comes to investments, the best thing to do is to do nothing. And that takes real discipline, right? On this chart here, Housing, what do you notice about this chart?
The line always goes up no matter what happens.
That's right. There's a wiggly orange line in the middle of the chart, and it goes up, right? So throughout this past 50 years or so, through all the crises that you see there, right? We have, what do we have? We have dot-com bubble, we have 9/11, with the Iraq war, and you can see that although there are fluctuations, the market always recovers and the line keeps going up. Right? Even this year, right? Just earlier this year, at the onset of COVID, the markets fell by more than 30%. But now we're, more or less back where we started. So from here, you can see that the market has a return because it goes up over the long term. And this return is fueled by things like population growth, higher standards of living, and increasing demand for goods and services. Right? So if you want to participate in this return, discipline is key. To look beyond the concerns of today, stay invested, and tap into the long-term growth potential of the market. Now, at the start of this talk, I spoke about investing versus speculating, right? It's a really important point because we believe that investing is an important part of a person's overall long-term financial plan, which helps us to achieve our life goals, such as, we talked about earlier, financial independence. So let's take a look at the next slide. Right? And here I want to share with you the money owl approach. Now, unlike speculating, the reliability of investment return is key. Now, we want to be sure we have enough to meet our goals. So it is this philosophy that really guides the money owl approach. So let me just summarize what we've already talked about so far. Now, it's difficult to pick the right stocks consistently, even for professional fund managers. So diversify. Don't time the market because your investment behavior is affected by your emotions, and reacting can hurt your investment performance. A major crisis happens every now and then. In fact, we're still in the middle of a crisis, but no matter how bad it is, the market always recovers. Start investing early to leverage on compounding returns and invest regularly to participate in market returns. And finally, keep your costs low. Now, we'll talk about costs in a little while. Before that, I want to introduce dimensional. Right? So we can take a look at the next slide. Now, to enable Money Owl to implement such an investment approach for our clients, we use funds from Dimensional Fund Advisors. They are a leading global investment firm based in the US, and in their own words, they've been translating deep academic research into investment solutions since 1981. So for close to about 40 years by now. Now, the next slide here describes Money Owl's investment strategy. Now, you can probably see right away why Money Owl would offer dimensional funds to our clients. Dimensional as a market-based investment strategy where they do not time the market or pick stocks, and they invest broadly across sectors and countries, right? Very much in line with what we've discussed so far. In addition to all that, they rely on their deep Nobel Prize-winning research to gain insight on market returns and integrate that knowledge into their portfolio management strategies to add value to investors. And they do all this while keeping their fees low. Now we come to fees, right? Now, as an investor, it is important to realize that fees is the one thing you can control in your investment decisions, because you can always decide whether you want to pay the fees or not. Now, here's a table that compares the fees between a typical actively managed fund and dimensional funds, which are, as you recall, market-based funds. Now, the expense ratio, and you can think of this as like a management fee, the expense ratio for actively managed funds are a lot higher. So you can see here, it's on average 1.89% compared to just 0.3% for dimensional funds. Because why? Because you're paying for all the salaries and bonuses of the analysts, the fund managers to do all the research on which stock to pick, when to time the market, and so on and so forth. And all this, even though we just went through the illustration of Orlando the cat and all that, even though we saw that very few of them actually get it right and manage to beat the markets, but yet, these fees, you still have to pay. So on top of that, there are other types of costs which are hidden to investors like yourselves, because because active fund managers are constantly trading in and out of the market because they need to time the market, they need to select and pick the stocks. They're constantly trading in and out of the market, and trading incurs transaction costs. And then there's cash drag, which is the opportunity cost of holding cash instead of investing the cash. Now, all this adds up. It all adds up and is passed on to the investor. What this means here is that before a single dollar of return is earned, you need to commit close to 2.5% in fees to the fund manager. And you need to pay this year after year, right? Which will definitely drag down your overall returns. Now, on the other hand, dimensional funds are low cost, which gives them an immediate advantage over active funds. So don't pay large amounts of money to fund managers who claim to have a crystal ball into the future. Instead, trust in the evidence of long-term market returns. Now, with that, I want to share with you the investment portfolios which Money Owl offers. Now, a portfolio, right, is basically a selection of different funds which are held together in a particular percentage. At Money Owl, we have 5 different portfolios which are all built using dimensional funds. They range from a conservative portfolio, which has 80% allocated to bonds, right, and only 20% allocated to equities or stocks, to an equity portfolio on the right-hand side, which has 100% allocated to stocks. And now the other portfolios, like moderate, balance, and growth, are basically in between with varying percentages of bonds and equities. Now, recall we said that while equities deliver a higher return than bonds, they're also more volatile and fluctuate more. You may remember that the chart which Housing showed, that the lines are a little bit more jaggly, right, if there's such a word. So a conservative portfolio would be more stable and less volatile. But because it holds less equities, the projected returns are lower than other portfolios. But on the other hand, the equity portfolio gives the highest projected returns, but you can expect a more bumpy ride if you hold this portfolio. And that's also the reason why we want to highlight the recommended horizon for each portfolio, which you see here on this slide as well. Because while the market delivers a return over time, in the short term, prices can still fluctuate, and you do need a certain runway to ride through the volatility. Now, if you're not sure which portfolio is suitable for you, not to worry. Our robo platform actually does the risk assessment for you. It helps to determine your ability and willingness to take risks, and thereafter it assigns you the most appropriate portfolio. So on that note, we'd like to do a quick demo of our investment service, and Housing will take us through that. Over to you, Housing.
Okay, thanks, Harry. So we have almost come to the end of our presentation here tonight, right? So hope everyone has learned something, right? Hope that you feel a lot more comfortable investing, right? I will most likely start investing in the next few days, okay? Knowing the importance of investing and how to manage your emotions and things like that. So here is actually the easiest part, which is to sign up, right? The whole process on Money Owl takes around 5 minutes. So it's actually really easy. Okay, so it's good if all of us can actually, follow along. That would be very good. Okay, so first thing is to do is to go on to our moneyhour.com.sg, right? www.moneyhour.com.sg, and click on services, right? And then investment. On the investment web page, you can then scroll down to look at what is our philosophy, our fees. Okay, who is Dimensional, right? So some of you all may be very curious, which is the fund manager that we're actually using for our funds, for our portfolios, right? So you can click on this link to know a little bit more about the fund manager, right? And you can, of course, read our investment resources at the bottom of the page. Okay, so once you're comfortable, you can click Start Investing and press Get Started. So here you see two different kinds of portfolio. The first one is investment portfolio, and the second one is Y-Saver portfolio. Recall just now we talked about cash solution, right? So this Y-Saver portfolio is like a cash solution to put your emergency funds inside. Okay, but however, for this presentation, we just want to talk about investment portfolio and how to set it up. Right, so you can click on Choose Investment Portfolio. You can use your cash or SRS for the portfolio here. Right, if you do not know what is SRS, you can click on this tooltip here, or you can email us and we'll let you know more about what it is. Right, so here we're going to use cash. We're going to select the investment time horizon that we have. Okay, and the amount needed. So here at Money Hour, we really encourage everyone, no matter how much assets you have, okay, right, to try and invest a little bit of money. Right, of course, you have to fulfill certain criteria, like for example, having emergency funds and things like that. But we try to lower the barriers of entry, and that's why the minimum amount, okay, to invest, we have lowered it to $100, and for monthly, it is $50. Okay, here we may ask you certain questions, right, just to make sure that you're suitable. Okay, and we'll ask you whether you have the 3 months of emergency funds. Okay, so if you click yes, right, you'll be brought to the next page where we just ask you another 4 questions to see how willing you are, okay, to take risk in your investments. Right, so the robot will then give you a recommended portfolio, in this case, a balanced portfolio, right, which you can view. And then we'll show you a simple illustration of how much money you can expect to receive at the end of your investment time horizon. You can also feel free to run through some basic info of each individual funds here. And then you're going to see the fees stated here. Okay, so the first thing to do is actually to create your Money Hour account. Okay, so all you need is these details: your name, your email address, right, your password, and handphone number. Okay, I shall skip through a little bit. Okay, so when you click agree, right, you'll be asked to verify using your handphone number. Right, then you can click OK. So the account is created. Right, please verify your email address. So you can alternate tab to go to your Gmail, Hotmail. Okay, find our email address and click verify. Yeah. Okay, so the next step, right, is actually to log in using the username and password you have created. Okay, here you come to our dashboard. Right, you'll notice that instead of, other than investment, you're going to see other things like will writing, you're going to see things like comprehensive planning. Okay, it's because investment is just one of the things we do. Right, but for this presentation, we just want to talk about how you can set up the investment account. Right, so just now we have created the MO Money Hour account. Here we are creating this thing called the investment account. Right, so take note that there are actually 2 different things. So you can use the MyInfo or you can do it manually. Right, we recommend using MyInfo because the process will be much faster. Okay, so everything will be auto-populated already. Right, sometimes we may miss certain fields, right? So you can manually key them in. Okay, so this process shouldn't take more than 5 minutes. Right, so here we are going to show you the important notice. Right, at this stage, we're going to show you all the final details that you might be interested in. For example, the turnaround time for your transactions. Okay, you'll be able to see, things like that. Okay, if you sell, how long do you need to take? Right, all the final details will be here, including all our fees. So notice that we keep flashing our fees at different parts of the account opening process. Okay, that's because fees is something that Money Hour is really proud of, right? We charge extremely low fees. And now, okay, until the end of this year, if you were to invest $10,000 or less, right, you have the fees rebated back to you by the end of next year quarter, the first quarter. So all the fine details will be here. Okay, what kind of risk that you'll be exposed to when you choose our portfolios. Okay, so we let you check one last time before you confirm. Okay, confirm your funding method. Okay, and then you'll be asked to name your portfolio to anything you want. Okay, so now your portfolio is ready to be funded. Click proceed. Right, and then there will be instructions along the way to tell you what to do. Okay, so you can either use a bank transfer or you can just use the Pay Now feature. Right, we really recommend using Pay Now because it's a lot faster. Okay, so just follow step 1 to step 6 and your account will be created immediately. Okay, so between the account creation and using the funds in the dashboard, it will take roughly 4 business days, right? And after that, you'll also be able to see this top up button at the top right of the card where you can top up your investment portfolios. Right? Okay, so with this, hope everyone can follow so far. I know it can be quite a number of steps, but along the way, if you encounter any problems, you can always call in to us or you can email us at enquiries@moneyhour.com.sg, right? And our customer service team will be there to help you. Yep, so now we have come to the end of the presentation, right? So if you have any questions, maybe we can start to answer them.
Okay, thanks everyone. I see some questions in the chat. Let me just go through them. Okay, let's see. Now, okay, we have one question, which is from Adrian, I believe, right? What is with the current number of robo available in the market, like Money Owl, Scythe, Stashaway, how should one go about choosing what's suitable for each individual? Right now, it's true. Those of you who have been following robo advisories platforms in the past, year or two, may see that there's a lot of robo platforms that came up, right? Some of those which I've mentioned here. Now, it's important to know what is the difference between each of them, right? So now, not all robo-advisory platforms are the same, right? And each have their own different investment philosophy. Now, we're just going through, in the course of our presentation, what is the Money Hour investment philosophy? So this is all summed up in a slide before you, right? Diversification, not timing the market, importantly, keeping your costs low, and not picking stocks and things like that. So these are actually market-based investing. Now, Scythe and Stashaway each have their own different investment philosophy. Now, they would, for example, Stashaway, the focus is a little bit more on picking active funds, and they also allow you to actively pick which stocks and which funds you want to construct your portfolio. So in a sense, they are more of active management, right? They're more promoting of an active management style of investing. Now, Scythe is similar, but what I understand is that Scythe has an increased higher focus on REITs, right? So how should one go about choosing which platform is suitable for you? Well, that's really about what value proposition really speaks to you. Now, the other differentiation also is the fact that Money Hour, we don't really consider ourselves a robo-advisor in that sense, because at the beginning of the presentation, I mentioned that we are Singapore's first bionic financial advisor. So what's the difference, right? So in a robo-advisor, what you do is you interact with the robo, and then after that, the robo actually places your trade, and it gives you a dashboard for you to monitor your investments. At Money Hour, we have all of that, but in addition to that, we have the element of human interaction. So at Money Hour, you are assigned a financial advisor who will follow you through a journey of investing. So your advisor will contact you, and you are free to actually reach out to him at any point in time in order to receive advice about your investments. And in case markets are volatile, right, he may be able to reach out to you, or you can reach out to him to discuss about your investment plan for yourself. Now, I think probably one of the key differentiating factors, and also mentioned in my first slide, is that we are a social enterprise, right? So recall that Money Hour, we are a joint venture between NTUC Enterprise and Provident. Now, we have the decades of experience in doing well and doing good for the mass market in Singapore. So in that sense, we have that stability, that foundation behind us in order for us to see through our commitment to our clients. Yeah, I hope that answers the question. Let's see.
I think we've got a question from Jennifer Lee, right? She asks, can we see the performance of investment by logging into the MO page? And if we decide to withdraw out from investment, can we see the projected returns? I'm not too sure what you mean by the second question, but for the first one, yes, you can actually see the performance of investment, right? So we'll show you a couple of return metrics. So we do have simple returns as well as time-weighted returns for your reference, if you're keen, right, to look at them.
Now, okay, there's one question here. Let me just look through this by Jamie Tang. If I buy stock X and see that its share price dropping even lower, but I believe in the stock and would like to hold on to it as a long-term strategy, does it make sense for me to buy more stocks to even out my overall average unit price? Okay, so this is an interesting question, and I understand why many of us have this mindset, because it's really because you may have heard of dollar cost averaging, and your friends or family might have advised you that, you know, if the market prices are going down and if dollar cost average, then you're proportionately holding a lower weighted average price of the stock. Now recall, right, the presentation which Hao Xing showed just now about the Apple, GE, and Creative. Now you can see that, well, you can see that this is not always the case, right? Like in the case of Creative, right, it was actually at over $50 in the late 1990s or early 2000s, and today it's $240. Now, if StockX was Creative and you had used this strategy and bought into the stock as the stock prices were going down, you know, that would have been a very bad strategy. I don't think that would have worked out very well for you, right? So there's no guarantee, as we said before, that any particular single stock would actually, in a long term, recover or even, go up and go back to the levels where it was, right? So we took a look at the examples of GE and Creative. So I think the better thing for it to do is to actually look at how a globally diversified portfolio would be more suitable, because in a globally diversified portfolio, you're not just invested in a particular one stock or two stocks. In a globally diversified portfolio, you are investing in hundreds, if not thousands of stocks. And the idea is that if one stock fails, then your risk is proportionately lower. Now, in the short term, a globally diversified portfolio might fluctuate, it might go up and down, just like a single stock might do. But I think the difference here is that if you trust in the power of the markets over time, over the long term, the market always goes up because, as I mentioned, this is based on real economics. Whereas for a single stock, within the company, we don't know what is the actual situation, right? Whether you actually recover over the long term is uncertain. So I think the better strategy to adopt is to adopt a market-based strategy by holding a globally diversified portfolio over long term. Yeah, I hope that answers the question. Let's see, do we have any more questions over here? Estelle, I believe my colleague has answered your question, right? Okay. Yeah, there's one question here.
I think maybe we could add on to what Estelle's question, right? We could address it further, right? So you mentioned that what is this 0.3%, right? So this 0.3% is the expense ratio of the underlying fund. So typically when you buy unit trust, right, you'll be able to get hold of the fund fact sheets. So usually at the right side or at the bottom of the fund fact sheet, you'll be able to see what is this total expense ratio. Some of us, we call it the OCF, right? The overall ongoing charges figure. So this one represents the total amount of cost that you pay to the fund manager, as well as the cost that is associated with delivering the fund. For example, for advertising, for marketing, for regulation and so on. Right. So this is different from the amount that you are paying to Money Hour. That will actually be the advisory fee, right, which is the 0.6%.
Okay. There's one question here, and I will try to answer it. It's actually asked by Kay to me privately. So I'll attempt to read the question, and then I'll ask the question. I'll read the question out loud so that all of you can hear the question. Right? It says, many thanks for the presentation. A question. So we talk about long-term investing, potentially more than 5 to 10 years, and end users like us rely on you guys to help us with the investment. And now years down the road, if for any reason the company closes, I assume he means if for whatever reason Money Hour closes, what happens to the funds, right? I'm asking from a more positive angle, such that if your company is doing well and it goes private, such that the mass market commoners like us cannot meet the minimum investment amount, then how? Okay, that's a very interesting question. Thanks for that question, Kay. Maybe let me answer the second question first, right? Which says that if we're doing so well, and then if we go private, and then if we raise our minimum amount, then what happens to mass market commoners? Now, let me just assure you that Money Hour was set up as a social enterprise and will always continue to be a social enterprise, right? This is the mandate and mission of the company together with our shareholders, NTUC and Provident, right? So our purpose is actually to serve the mass market. So it's not, so you may notice, and those of you who have used, who are familiar with the financial advisory industry will know that our parent Provident actually is also a financial advisory firm. And then they cater more to a middle affluent market, right? And there was always this passion to serve the mass market. And so that's how Money Hour was born as well, right? We were born out of a desire to serve the regular man on the street, right? So I doubt, so what happens if we do well? I think if we do well, we will continue to grow and we'll continue to use what we have achieved to continue to serve the mass market. I think we will not, it's unlikely that we would increase minimum amounts to push out the smaller investors, because that's totally not what we were set up to do. So I think that hopefully answers that part of the question. Now, the other question asks about what happens if years down the road, the company closed down? What happened to the fund, right? I think for this question, it's interesting because for all our investors, the funds are actually held in a trust account, right? So it's not that the Money Hour will hold the funds for you, such that when Money Hour closed down, your fund goes down together with money hour. That's not the case, right? Your money hours are held in a trust account. Your funds are held in a trust account. And so what happens if money hour decides to close down? Well, your fund still belongs to you because they're held in trust for you. So then what happens is that either your funds will be assigned to another financial advisor, or there'll be a process to return the funds to you. So do note that Money Owl is, as a financial advisor and also a capital markets license holder, is actually regulated by the MAS. So there will normally be a orderly conduct for these kind of matters, but not to worry. If you're worried about your funds going down with the company, that won't happen because your funds are actually not owned or held by Money Owl, it's actually held in trust. Any more questions? Quite a few here. Okay, there's one question here. Let me see. Okay, there's one question here from Veronica, right, which says, thanks for the introduction. How does investing with Money Hour compare to buying into the S&P 500 regularly? Since there will not be any commission when buying the S&P 500. Okay, so I assume you mean a kind of a S&P index fund, right? A fund which tracks the S&P. So maybe let me answer the question. Let me answer the question this way, right? So for those of you who are not as familiar, right? S&P 500 is actually a US-based market index, and it's the top 500 corporates in the US, right? And they put them together into S&P 500, and then you can actually buy into the S&P 500 through an ETF or through an index fund. Now, for an index fund like S&P 500, what happens is that the index fund is actually constructed to mirror the S&P 500. So the return that you get is actually based on the index, the actual index, right? So when you actually buy into S&P 500, you're actually buying into the US market earlier, because as I mentioned, the S&P 500 is US based and puts together the top companies in the US market. So US company has performed very well, right? As you can see in the last 10 years, but that's not always the case, right? So coming back to the point about holding globally diversified portfolio, in every period of time, there will always be a country, a region, or a sector that's doing well, right? Today, it could be US, tomorrow, it could be an emerging market, and then so on and so forth. So so what we think that further diversification beyond S&P 500 would be good. And maybe I can talk a little bit about the dimensional, right? So while S&P 500 is US based and it's an index fund, now dimensional is not that it's similar in the sense that dimensional funds are also market based and non-forecasting as a basic principle. But unlike index funds, which like the S&P 500, they do not need to mirror the market index which they track, right? In fact, dimensional funds are often even more broadly diversified than the index funds such as the S&P 500 index, right? And one thing you have to understand is that also when you buy S&P 500 indices, there are some fees which you may or may not see, right? So for example, brokerage fees, right? Trading fees when you buy and sell the S&P 500 index. And then for ETFs and index in general, usually there's a bid-ask spread that you will have to pay whenever you trade in these stocks. So these are important points to consider as well. Okay. Are there any more questions? Okay, there's one from Colin. Recently, Smartly started the same time as Stashaway has closed down. How does Money Hour say sustainable as a business since fees are so low? AKA good for investors like us. Okay, I think this is a good question, and I think those of you who have been following the robo-advisors would know that recently Smartly, which is a robo-advisor, similar to Stashaway, as Colin mentioned, has closed down. Now, it's true that sustainability is a challenge, right, for robo-advisors, because we mentioned about the fees, right? The fees are not high, right? 0.3%, 0.6%. These are not very high. So the margins in this business is actually very low. So it is very competitive, right? So even for the likes of Stashaway, Smartly, and so on, it is operating together with us, operating in a very competitive environment. Now, let me put it this way, right? A lot of these robo-advisors are funded by VCs, right? For VC stands for venture capitalists. So what they do is they take a punt on businesses, startups, put in money to help them grow, and after a particular period of time when the startups grow into a certain size, then what they are looking for is they're looking for an exit to turn over the investment for a higher return. Now, and if that doesn't happen, if that size, if that scale doesn't happen, then the funding stops. And what happened to Smartly can easily happen to many other robo-advisors. Now, Money Owl is not a VC funded entity. As I mentioned, we are funded by strong shareholders, right, such as NTUC Enterprise, as well as Provident. Now, so we continue to enjoy the strong support of our corporate parents, as well as the strong support of MAS for doing our business. Now, I mentioned also there's important distinction between ourselves and the rest of the robo-advisors, because Smartly and Stashaway are indeed robo-advisors, because what they do mainly or only is manage your investments. But Money Hour is not the same. For Money Hour, investments is just one of the business that we do. Now, we also do comprehensive financial planning, and we have also will writing, and we also have insurance business. On top of that, we also have a corporate business. So all these other business streams helps us to stay sufficiently funded in order to operate as a going concern going forward, right? So in that sense, we are in a stronger position, right, because of our parentage and because we have other key business streams that support ourselves in addition to just investment, which, as I mentioned, operates in a very thin margin environment. I hope I answered the question. Now, thanks for all the questions. Really appreciate that. I'm just trying to go through the questions to see if any had not been answered. Thank you for all the helpers at the background. So you may notice that if you post a question, it could have been already answered by our advisors who are also tuning into this webinar. They're helping to answer all the chats, answer all your questions via the chats, right? Okay. Now, I believe, if I'm not wrong, most of the questions had already been answered. Maybe, Hao Sing, I can just ask you one last question before we close.
Yep, go ahead.
Right. So after all that we've said and done, is now the right time to invest?
Well, the best time to invest is really over. You should have invested long time back. But the second best time to invest is now, right? So if you're 25 years old, right, if you're 45 years old, there's no better time to invest than right now, okay? We understand that now the market is pretty noisy, right? In the US, for example, we are seeing, some argument, okay, right, about, the fiscal support stimulus and things like that, right? We know that the COVID situation is not very stable, right? But the same things have actually happened over and over for the past decades and so on, right? So if you miss this time, right, maybe the market would have gone up and you have thought that the price is very high, and then you you wait again and procrastinate, until you miss out altogether on the returns, right? So like what we have always mentioned and emphasized, right? There's no better time to invest than right now. Always start early because of the power of compound interest. Yeah.
Okay, thanks, Hao Sing. And
Yep.
thanks everyone for listening in all the way until now. We appreciate that this is close to dinner time for many of you, and you've made an effort to join us here. We're fully appreciative of that. So in case we've not managed to answer your question, or in case you have more questions to answer and you would like to contact us to find out more, please reach us at enquiries@moneyhour.com.sg. So the email address is enquiries@moneyhour.com.sg, or alternatively, you can also contact us via Facebook Live. Now, Money Hour constantly has different events being held at different times. Okay, in fact, there is another session on which is actually together with our CEO, and that will be tomorrow. It's an Ask Me Anything session. I think this is together with Sidney, if I'm not wrong, right? And if you'd like to find out more about investing and the Money Hour approach of investment, do tune in for that session as well, right? Alternatively, as I mentioned, do reach us on Facebook Messenger or via email at enquiries.com, enquiries@moneyhour.com.sg. Now, thank you all. Yes, thanks, Juntin, also for the link. I think you put a link there for those of you who are interested to attend the talk for tomorrow. Okay, thank you all. I think we've come to the end of the webinar. Once again, thank you very much, and we wish all of you a good evening. See you later. Bye-bye.
Thank you. Bye-bye.
Thank you.